Hi everyone. We will start in the next few minutes. We're just going to give a few more minutes for some more people to join if they're joining. But in the next 2 to 3 minutes, we will get going. I will share the question we'll be covering now. Just give me 2 minutes. Okay, so I'm going to get started now. I'm just going to put in the chat the question we'll be covering. Maybe put it open the group in WhatsApp. Um, where did I save it now? Okay, so you should find it in the group. It's on page 42. We're gonna do the valuation question on Kusela. Let's just quickly open it, and then I'm gonna start reading the question. So the way we're gonna deal with the question paper, I'm gonna read the scenario. As we read the scenario, I'm going to explain to you how to think through a free cash flow question, and then we will be tackling this particular free cash flow question. So as you do the question, I'll explain to you the thinking approach, the theory behind it, and all of those type of stuff, so that you can handle any free cash flow question that comes your way. Just tell me once you have it open. Okay, so can we get going? You can hear me, right? Yes. Just give me a thumbs up if you can hear. Madania, Nondumiso, you can hear. Okay, cool. Okay, so I'm gonna get started now.
I can hear here.
Okay, perfect. So it's not this question. We just see what question did I choose? Question I chose was page 47, Kosela. Okay, so page 47. Yeah. So this is question 11, Kusela Pty Ltd. Okay, so I'm going to start reading the question. So we're going to be we won't be focusing on this part, this is financial statement analysis. We will be dealing with this part over here, equity valuation. But I just want to read the background to the scenario so that we have some picture what's happening. So this Kusela Pty Ltd is a company that manufactures and installs vehicle tracking devices and performs tracking services for various clients in South Africa. Customers who purchase devices from Kuselo can choose to subscribe for tracking services with Kuselo or any other service provider. Kuselo has been in operation for the past 10 years and has chosen to remain an unlisted entity. The following information of Kuselo has been correctly prepared by the management accountant. Okay, so here you can see extract. So giving us an extract of statement of profit or loss of Kuselo for the periods ended 30th March. So there we can see revenue 2018, 2019, cost of sales, gross profit. Then we have common size analysis, and common size analysis is based on the revenue. And then we have subscription revenue. So they're giving us that information. Okay. Then they're saying proposal from Izinga Ltd. So they say Izinga manufactures and supplies various mechanical parts for motor vehicles to distributors across Southern Africa. Izinga have communicated to Kuselo that they would like to initially acquire a 60% interest of the existing equity in Kuselo. After a year, they would then like to acquire the remaining 40% equity interest and merge Kuselo and Izinga. Izinga plans on financing the acquisition of Kuselo by means of a share exchange. Okay, so this is where we're going to focus. Okay, so we're going to focus on the valuation question, this equity valuation question. So they say equity valuation of Kuselo. Ms. Shishisa, the management accountant of Kuselo, took the initiative to prepare the following calculation of the equity value of Kuselo based on the earnings multiple method of valuation. So it's value of equity, profit after tax times price earnings ratio. So value of equity of Kuselo is 247 million times 11, which give an amount of 2.73 billion rand. So they say where 2019 profit after tax, 2019 profit after tax of Kuselo is 247. 2018 profit after tax for Kuselo is 182 million. The price earnings ratio, 2019 price earnings ratio of Izinga is 11. Okay, so how this management accountant worked out the profit, the value, the price earnings multiple, the formula is correct, which is profit after tax or earnings multiplied by the PE ratio. So the formula is correct. The question you would have, if they had to ask us regarding this, the question we would have to ask is, why the 2019 profit number? Okay, so there are certain reasoning that have to be applied in order to use the 2019 number. Okay, second, the price earnings ratio is correctly being used of a comparable company. However, you can't just use a comparable company as is. You need to obviously adjust the comparable company. You need to adjust the comparable company's earnings ratio to the price earnings ratio to reflect your own company. Okay, so there are obviously a few questions we can ask regarding that, but that is not the topic of today. So they say forecast financial information of Kuselo. Okay, so the CFO of Kuselo compiled the following projected financial information to prepare for the possible negotiations with Izinga. So capital expenditure, depreciation and amortization, interest expense, investment income, tax expense, and profit after tax. Then there are notes for each of those. There are notes for most of those numbers. So let's say the notes to the forecasted financial information. Capital expenditure represents the planned capital spent on additions to property, plant, and equipment. Interest expense relates to a long-term loan which has a market value of 500 million rand. Kuselo invests excess cash after considering the operational requirements and capital investments in short-term deposits. The cash is expected to earn a pre-tax rate of 11% per annum. Okay, the tax expense is based on projected taxable income. Okay, so that is what we need to consider. Then we have working capital requirements. We have current assets and we have current liabilities. So they're giving us that information. And we have some additional information. So they say the current inflation rate is 6% and is expected to remain the same for the foreseeable future. Kuselo's target debt equity ratio. Kuselo's target debt equity ratio is 25%. Kuselo's pre-tax cost of debt is 12.5. The beta coefficient of Kuselo is 1.15. The current annual yield on long-term government bonds is 6.25, while the basket of listed companies in the same sector of Kuselo's operation has averaged 16.25%. Assume a corporate tax of 28%. Kuselo expects its cash flows to grow at a stable rate of 6% per annum from 2023 onwards. Okay, so we'll explain all of those information. So we're going to focus on this one over here. Okay, so let's say calculate the fair market value of a 60% equity interest in Kuselo as at 30th March 2019 using a free cash flow method of valuation and the provided information. They say note, provide detailed calculations of all inputs and round to the nearest thousand. The starting point of your valuation should be profit after tax. Okay, so that's important, where to start. So your NISA will generally tell you where to start. Okay, and the reason why they tell you that, because if they don't tell you, you can start with a different number and make your calculation easier. So they specifically want us to start with profit after tax because it requires more adjustments, and they're obviously doing that in order to help us understand, to see whether we understand what adjustments needs to be made. Okay, so that's what we're going to focus on. So now I'm going to switch over into Excel, and I'm going to then we'll work through this question. I'll also explain the process that you need to think about when it comes to a free cash flow calculation. So remember, what's important to note is that with valuation questions, there are many valuations, right? You have free cash flow, you have earnings multiple, the PE ratio. So you have free cash flow, the earnings multiple, which is typically the PE ratio. You have the dividend or the Gordon growth model. You have the NAV method. Then you have the spin-off of the PE multiple, which is the earnings yield, which is basically the inverse of the PE multiple. Okay, so those are the typical five that you must be able to know. So you must focus on make sure that the two big ones is going to be the PE and free cash flow. The Gordon growth or dividend growth model can be big, but it's hardly ever super big. Okay, like an 18 marker, you're not going to get an 18 marker on the dividend or the Gordon growth model. It can be, but you hardly do get a question like that. But for PE and or earnings yield and for free cash flow, it's going to be around 15 and upwards. Okay, so you must develop a thought process of tackling a PE multiple question. You must have a thought process of tackling a free cash flow question. So you must understand, when do you use a free cash flow? So when do you use, number one, if they tell you to use free cash flow, then you use it. But if I must ask you which method to use, you will typically use a free cash flow method when you want to acquire a majority stake. Okay, so when you want to work out the value for a majority interest, then you'd want to use a free cash flow method. Similarly, if it is if you are acquiring a private company, a PTY Ltd, and you're acquiring a majority interest, then you would also then you could also use the free cash flow, or you would most likely use the PE valuation. So typically, when there's a private company involved, they typically use the earnings multiple method. But in this question, they told us to use a free cash flow. So take note, whenever there's a majority interest, you would either use free cash flow, or you would use the earnings multiple, typically PE. Okay. So just be aware of that. When you have a minority interest, then you'll typically be using the dividend or Gordon growth model. The reason why, so why do we use the free cash flow or the earnings multiple for majority? And why do we use the dividend growth or Gordon growth model for a minority interest? So think about it. If you have a minority interest, you don't have much say in the operations and the financing of the business, right? So your return for having minority interest is purely a dividend. And that is why it makes sense to value your stake using the Gordon growth or the dividend growth model. When you acquire majority interest, then you basically have control regarding the decision making around operations, around financing. So you can directly impact revenue, you can directly impact cost, which basically directly impacts profit after tax, right? And you directly impacting the cash flows and all of those type of stuff. So you have a big say, and that is why you can then, because you have control over those numbers, you can value the company using PE, which you can obviously adjust those numbers, and similarly you can use the free cash flow because you can create projections. So that is kind of basically the whole point of why you use a majority interest for why you use free cash flow or PE for majority interest, and why you use a dividend or Gordon growth model for minority interest. Okay, so those are the three typical. Now remember, the earnings yield is simply the inverse of PE. So when you study PE, one time study earnings yield. Okay, so that's all the four. So the fifth one is the net asset value method. The net asset value method, you shouldn't be using as your main valuation method. It should be used only as a reasonability check. So sometimes they will tell you to do the net asset value method, and you just do it. But if they must ask you regarding it, we'll always say the net asset value method should not be used as your main valuation, but should be used as a reasonability check. Okay, so just take note of that. So now we're going to focus on the free cash flow, how to set up the free cash flow method, okay, and the thinking process regarding it. So I'm going to take about 10 minutes to give you a high level overview of how to set up the free cash flow method, and then we will tackle this particular question. I'm going to stop shares. I just need to open up Excel. Do you have any questions at this point while I open up Excel? Shaheen, Nondomiso, Marinia. Okay, so you should be able to see the Excel in front of you, right? So, let me just see what's in the chat. Okay. Yeah, if you have a question, just raise your hand and then I'll have a look. Okay, I'll stop and have a look. Okay, so with the free cash flow method, there's two parts to it. Okay, so you will have the explicit period and then you will have the terminal period. Okay. So remember with evaluation, particularly when you're valuing an equity interest, it is basically a valuation forever and ever. Okay, so you're basically working out the value forever and ever into the foreseeable future, right? So what we do over there, we set it up in two parts. The explicit period is basically the period where you have information for each particular year. So in this question, our starting point, I told you where the value must be. The value must be at 30th March 2019. Okay, so basically 30th March 30 March 2019. That is basically year zero. So your starting point is year zero. They must tell you what the starting point is. Okay. So that shouldn't be difficult. They should always tell you, because you can't guess the starting points. Okay. So they must tell you what the starting point is. So they told us 30th June 30th March 2019 is the starting point. So that is year zero. So the explicit period is the period where you have specific information. From a technical point of view, the explicit period should be as long as possible, and it should be for a period where you are able to forecast information as accurately as possible. So in reality, they would like this to be 10 to 15 years. Okay, for our purposes, it will be 3 to 5 years. Okay, but typically, so from a technical point of view, they want to value they want to have the explicit period to be 10 to 15 years at least. Okay, so you must forecast for 10 to 15 years. So why in the real world they hardly use the free cash flow method? Although the free cash flow method in theory brings you the most accurate number, the fact that you have to forecast for so long implies or inherently creates a problem because no one can forecast accurately enough. Okay, so that is why in the real world the free cash flow is not used that often. Okay, so so remember we will always split between the explicit period and then the terminal value. So the explicit period is the period where you have information for specific numbers. In this case, it is 30th March 2020, 30th March 2021, and 30th March 2022. So basically we have the explicit period is 1, the explicit period is 1, 2, and 3. Okay, so year 1, year 2, year 3, that is the explicit period. Okay, and then they said from 30th March 2023, in the additional information, from 30th March 2023, there will be the company will grow at a constant 6%. Okay, so how you will pick up what is the explicit period? The explicit period is the period where you have specific information. Also, the explicit period ends when there is a constant growth rate. So they told us from 2023, there's a constant growth rate for the foreseeable future. So you know that from 2023, there's a constant growth rate. So that means the explicit period ends in the period before that, which is 2022. Okay, so just take note, you must be able to pick up what is the explicit period. So the easiest way is to see where they have given information for. So they gave us information for 2020, 2021, 2022. So that is our explicit period. The second way you can confirm is to see when does the constant growth rate start. The constant growth rate starts in 2023. So therefore, the explicit period ends in 2022. Okay, so that's the first part. So you need to make sure you get this right. Okay, now we get into the details over here. Now we get into the details over here. In this question, they told us start with profit after tax. Okay, so they told us start with profit after tax. That's what they told us. So typically, you will start with a profit number. If in the real world, you will start with profit from operations. Okay, you would start with that number, which is basically earnings before interest and tax. Okay, so we will generally start with profit from operations. Okay, so that is generally what we'll start with. But you need to ask us to start with profit after tax. So the thinking process is as follows. Start with a profit number. In this case, they told us start with profit after tax. And in most tests and exams from UNISA, it's going to be profit after tax. Okay, so that's our starting point. Now the question is, what are we trying to get to? The whole point of a free cash flow valuation is to value the operations of the company. Okay, so the whole point of a free cash flow valuation is to value the operations of a company. So we want to start off with a profit number, and we want to end up with a cash flow from operations. Okay, so that is basically what we want to end up with. So that means we're going to make two types of adjustments. Okay, so remember, we're starting with a profit number, and we're going to end up with a cash flow number from operations. So there are two types of adjustments we will make over here. Number one, we will adjust for non-cash flow numbers. Okay? So for example, depreciation is included in this number, so we have to remove depreciation. Okay, so depreciation is included in that number, so we have to remove that depreciation in order to get to a cash flow number. That's the one adjustment. The second adjustment we need to make is in that profit number would be amounts that relate to items that does not form part of the core operations. Okay, so there may be financing stuff in this number, there may be investment decisions in this number. We only want, so therefore we need to take out stuff that is sitting in here that does not relate to the core business, that is not operational. So typically interest expense will be removed. Typically dividend income, investment income on assets that does not form part of your core business. So for example, over here, our business in this scenario is um, tracking devices. They told us they invest excess cash. Okay, so that investment in excess cash, whatever income it earns, does not form part of your core business. So therefore, we have to remove that investment income because it does not form part of our core business. Okay. Similarly, we have interest expense. Um, the interest expense also needs to be removed because it relates to a financing decision. It's interest on a long-term loan. What's important to take note regarding interest expense? You must have a look. What does the interest expense relate to? In this case, the interest expense relates to the long-term loan. That's a financing decision. But if the interest expense relates to what was it now? Overdraft, then you will leave it in because generally the overdraft is an operational financing amount. So therefore, because the interest expense relates to operations, we will leave it in. Okay, so those are the stuff you need to think about. So that's why the thought process is, what are we trying to do? We try to move from a profit number to a cash number. Secondly, we're not trying to get it to any cash number. We're trying to get to a cash from operations number. Okay, so it's very, very important to take note. We're trying to get to a cash from operations number. So the two things we adjust for is to remove non-cash flow, and the second thing we adjust for is to remove anything that does not form part of our operations, that is not form part of our core business. So that is any investment and financing income and expenditure. Okay, so just take note of that. So let's show you how we would do it over here. So remember, in year zero, we won't put anything in year zero. We must have the column, and no numbers will end up being here when we're dealing with this over here. Okay, because we're only looking at future things. So year zero represents now. So we need to value from year one onwards. So if we have a look at the profit number, they gave us the profit number. They said everything must be in the rand thousands. So the profit number is going to be 256,452. 256,452. You can just double check that I'm putting in the right numbers. Then 289,650. So that's you're going to find in that forecast from the CFO, and it's going to be 332,650. Okay, just give me 1 minute quickly. That's fine. Okay, so are we happy with that numbers? Now, included in this number, so I don't know what you can see now. What do you see in front of you? Excel or the question? You probably see Excel, right? So just make sure you have the question open with you. So basically we have this profit number of 256, 452, 289, 650, 332, 650. Now included in those numbers, if you look at the forecast from the CFO, would be capital expenditure, would be depreciation, would be included in that 256 would be the depreciation, would be the interest expense, would be the investment income. So we basically need to adjust for those. Depreciation is non-cash flow, so therefore we need to adjust. Interest expense is non-cash flow, therefore interest expense is financing, because they told us the interest expense relates to a long-term loan. And then investment income is also a non-operational amount. It is a investment amount, because I said that relates to excess cash being invested into short-term deposits. Investing in short-term deposits is not our core operations, so therefore we have to remove it. Okay, so just take note of that. So we're happy with that. So let's have a look. I'm going to put in, I'll start with the interest expense. What do you see in front of you at the moment?
Excel.
Okay, so just make sure you can see the numbers from the scenario so that you can see where the numbers are coming from. Okay, so now we're going to be adjusting. Get that. Okay, so the interest expense, just make sure I'm using the correct numbers. So now what we're doing, we're going to remove all non-core items. Okay, so interest expense. Okay, so if I have a look, that is 4320. So now I'm going to put in 4320. Now the question is, what do I do with it? Do I add it or do I subtract it? So because you want to remove interest expense, you must do the opposite. So the thinking approach is as follows. What did interest expense do to profit after tax? Interest expense reduced profit after tax, but we don't want interest expense in profit after tax, so therefore we need to add it back. Okay, so therefore it will be a positive. Then we will just say tax on interest expense. Okay, so then the tax would just simply be equal to negative that amount times 28%. Okay, so just take note of that. Then, I want to do now. Sorry, I took the wrong number. It is 56,000. Okay. The next is going to be, the next number is, so it's all 56,000. Okay, so we're happy with that. Can you follow the numbers from the scenario? Yes, no? Okay, you find the numbers. Okay, so that's fine. So now we're going to do interest income. Okay, so with interest income, let's just go see. So with interest income in the forecast, they have 23,307. Okay, so 23,307. Okay, so 23,307. So I'm going to have what was it called now? Investment income. So yeah, I'm going to have investment income. Okay, so then with investment income, it was 23. What did I see now? 23,307. Okay, so now the 23,307. So the question we're going to ask us over here is, what did investment income do to profit after tax? Investment income increased profit after tax. We don't want it in profit after tax, so therefore we have to remove it. So what do? We will subtract it. Okay, so therefore this will be a minus. It was the same for all 3 years, so therefore we will simply do that. Okay, then we're going to say tax on investment income. Okay, so it will be the negative of that times 28%. Okay, so it will be yeah. Okay, so that is basically removing. Okay, so that is basically removing. So what did we do? We started off with profit after tax. So now we needed to remove anything that was non-operational. Okay, so interest expense, why was it non-operational? It is because it related to interest on a long-term loan. Okay, if it was interest on an overdraft, we must just check whether the overdraft relates to operations. If the overdraft do relate to operations, then we don't adjust for it because it is an operational expense. Then for the investment income, we removed it because the investment income does not relate to our core operations. It relates to income earned from investing in short-term deposits. Investing in short-term deposits is not our core business. So therefore, we have removed it because it's more an investment decision and not an operational decision. Okay, so take note of that. So the only thing we need to adjust for is depreciation. Okay, so if I just do this quickly, if I just do this, okay, so this is basically profit after tax. Okay, so that is basically profit from operations after tax. You don't have to call it that. I'm putting it there. This is just basically, they'll just usually say subtotal. Okay, so I'm just putting it over here. The reason I'm putting it over here is because just to show you what is that number. Okay, so you started with profit, you base out profit after tax, which is net profit, and you're removing um, non-operational items and you're taking the tax effect out as well. So basically now we were the profit number from operations. Okay, so this number is an operational number, but it's still a profit number. Okay, and we have adjusted for tax. So it's a profit from operations after tax number. Okay. So now we don't want profit from operations, we want a cash flow from operations. Okay, so we want cash from operations. So generally, in a typical valuations question, free cash flow question, we would start with this number, profit from operations. Okay, and then we will make the necessary adjustments. So the adjustments we will make now is to adjust to bring in to adjust for non-cash flow items. Okay, so we will adjust for depreciation and amortization. Okay, so the adjustment for depreciation and amortization, if we look at the scenario, they told us depreciation is 35, 45, 57. Okay, so 35, 45, and 57. The question is, what do we do with it? Do we subtract it or do we add it back? So we don't want depreciation. Okay, so what did depreciation do to profit? It decreased profit. But we don't want it in profit. So therefore, to remove it, we need to add it back. Okay. So now the question is, why do we not take tax into account over here? Okay, so we don't take tax into account for two reasons, basically. One, um, the one reason is that we may assume that depreciation and amortization is the same as wear and tear. Okay, so now we know wear and tear has a tax implication, and as a result, we don't. There's no need to adjust for the tax implication because we want the tax implication because wear and tear is a physical cash flow. Okay, that's the one reasoning. The second reasoning is even if depreciation and amortization is not the same as wear and tear, the tax number included in profit after tax would have the impact of deferred tax. So the impact of deferred tax would account for the difference between wear and tear and depreciation. And as a result, the tax number is correct from a cash flow point of view. So therefore, we don't adjust for depreciation. We don't adjust for the tax on depreciation. Okay, so just take note of that. Whenever you adjust for depreciation amortization, there's no need to do a tax effect because one way or the other, the tax effect is correct as it is. Okay, so just be aware of that. Okay, the next thing we will adjust for is capital expenditure, and it would be our working capital. So let me explain before I adjust for those two numbers. I just want to explain one more thing to you. So we have moment. So At this point, if we must add up these two numbers over here, okay, if we must add up these two numbers, then we would get a cash from operations number. Okay, we'll get a cash from operations number. Okay, so it is a profit number of operations, but on a cash flow basis. Okay, but now remember, the whole purpose of the free cash flow method is to value is to provide a value of operations. Okay, so the whole purpose of a free cash flow method is to provide a value for operations. Okay, we want to value what is the value of our operations. Now, what you must understand is, in order for a company to operate, they would need working capital. In order for a company to operate, they would need investment they would need capital expenditure. So let's explain that. Let's use examples that will make us understand. Think about Woolworths, Truworths, Pick and Pay, ShopRite, all of those guys, right? Think about them. In order for them to make revenue, um, they need, how do they make money? They are retailers, they sell groceries, they sell clothing, right? So in order for them to make money, they need to stock revenue. I mean, they need to stock groceries, they need to stock clothing. So in order for them to make money, they must have investment in inventory. So without inventory, there's no operations. Okay, so therefore, when we value operations, that is the reason why we bring in working capital. What are working capital items? Inventory, debtors, creditors. Okay, so without inventory, without the clothing, without the groceries, there's nothing for them to sell. And if there's nothing for them to sell, they won't make any revenue. And as a result, there will be no operations. So that is why the inventory is core to the operations. Now, if you look at Truworths, Woolworths, Foschini, those guys, like Foschini and Truworths, I mean, the last time was some years ago, but the last time I checked or read, I think like 90 to 95% of their sales is on credit. Okay, 90 to 95% of their sales is on credit. Same with Woolworths, a large portion of Woolworths sales is on credit. So, in order for them to generate the sales they are making, they have this credit facility, which is known as debtors. Okay. In order to have debtors, they need. So, debtors is a core part of the operations. Okay. So, without debtors, the revenue would drop significantly. Like for Foschini and Truworths, it would almost be zero because I think 90 to 95% is credit. So, that means 5 to 10% is cash. So, as a result, debtors is a core part of the operations. Without inventory, they can't sell anything. Without debtors, they may have inventory, but if they don't have debtors, their revenue will drop significantly. So there you can see inventory and debtors is a core part of their operations. Okay, so that is why it forms part of the free cash flow from operations calculation. Then with most retailers, most companies that have inventory, they fund a lot of the inventory through creditors, and that is why we bring in creditors as well. We don't want working capital. We want net working capital, which is debtors, which is inventory plus debtors minus creditors. Okay, so as you can see, why do we bring in working capital? It is because working capital is core to the operations. Without working capital, Pick n Pay, ShopRite, would have no business. Okay, so take note of that. Then for capital expenditure, okay, let's use a manufacturing company. Think about Coca-Cola. I'm not sure if you have been to the Coca-Cola factory, but if you have been, you'd understand. But I mean, just imagine it also. So with Coca-Cola, how do they make money? They make money by selling Coke, right? Or whatever. Let's just assume they only sell Coke. So they make money by selling Coke. So in order to sell Coke, they need to manufacture the Coke. Their whole operations is run through sophisticated machinery. Okay, so if you saw how they machine how the things all work, you would notice they have sophisticated machinery. So in order for them to operate, they would need to maintain their machinery, or if they want to expand, they'll have to buy more machinery. So therefore, for them, For manufacturing company, what's important is also the capital expenditure that they need to ensure. Without their PPE, they won't be able to operate. And that is why PPE forms part of the core operations. In the same way, working capital form part of the core operations, PPE as well. If you think about a pharmaceutical company, their patents, their trademarks would be form part of their core operations. Why? Because they manufacture drugs. Those patents gives them the right to manufacture drugs alone for a certain period of time. So those patents would form part, that is like their PPE, their intangible assets. So just take note of that. That is the reason why we bring them in over here, because for Coca-Cola, without the PPE, they have no operations. For Pick and Pay, ShopRite, Truworths, without inventory and debtors and creditors, or without inventory alone, they'll have no operations. There'll be nothing to sell. So just take note of that. Okay. So that is the reason why we bring in over here changes in net working capital, and here we'll bring in capital expenditure. Okay, so capital expenditure is easy in this question. They gave us the amount. The amount was 10, 25, 36. Okay, so 10, 25, 36. Okay, so it's capital expenditures and outflow. So therefore we make it negative. Do you have any question at this point before we move on? Madania, Non-Domiso, Shaheen. Any questions? Nothing? Great. So let's move on. So now we need to work out. We just add this up. Yeah, I'm gonna work out the changes in working capital. Okay, I'm just gonna put workings on the next sheet. I'm gonna put here workings. Okay, so for working one, we're gonna work out changes in working capital. In our scenario, they gave us current assets, and they gave us current liabilities. In an exam or in a test, you must take note. We mustn't just use current assets. In this case, we can, because they never gave us a breakdown. Okay, but you must have a. If they give you a breakdown, you must have a look what is included in current assets. You must have a look what is included in current liabilities. You only want current assets that form parts of the operations. You only want current liabilities that form part of the operations. Okay, so just be aware of that. So, for example, in current liabilities, there may be a short-term portion of a long-term loan. You don't want that included. In current assets, there may be cash. Now, remember, some companies have large balances of cash. They don't use all the cash for operational purposes. So you only include, for the cash portion, you only include cash that forms part of operations. Okay, so just take note of that. So we have, let me just do this. Okay, so it was 2019, 2020, 2020. Okay, so now let's have a look. So the current assets is what's the current assets now? Let me just go have a look quickly. Okay, so the current assets 232015, 232015, 232015. Just make sure I'm using the right numbers. And then it is 220125. So I'll make this negative. I'll leave it like that. yeah, just 220125. Okay, so we'll just make liabilities negative, assets positive. Then 256. And then we have 218490. Okay. Then we have 352,620. 352,620. This must be negative. Then we have 326,360. 326,260. 326,360. Okay. Just make sure I'm taking my numbers is right. 421,560. Okay. The next one is 421,560. Okay. The last one is 369,665. 369,665. 369,665. Okay. So this here is net working capital. Okay. So here's now a few important principles that you need to know. Okay. This is now a few important principles that you're going to need to know. Number one is the first, when you do a free cash flow question, and you must try to do this for all your valuations. Okay. PE, dividend growth model, the this one free cash flow, but particularly free cash flow and the PE multiple, as well as for a WACC question, as well as for a capital budgeting question, okay, NPV capital budgeting question. So the first part is to be able to do it, right? The second part is to make sure you can analyze a question. Okay, so for example, they give you the calculation and they say, dear student, please critically evaluate this calculation. Okay, so there are typical things in a free cash flow calculation that they will do wrong to see whether you pick it up. Okay, so in a working capital question, the one thing over here would be they will they will have a look whether you know which current assets and which current liabilities to include. So remember, if they give you a breakdown of current assets, you must only include current assets that form part of operations. Similarly, you only include current liabilities that form part of operations. Very important when it comes to current assets to have a look and to figure out what is the treatment of cash. So generally, you don't use the full cash balance for operations. So maybe they'll use 1% or 5% or 3% of the cash balance for operations, and the remainder is non-operational cash. Okay, so must be very aware of that. In this question, nothing specific, but they only gave us current assets and current liabilities, so we can assume all of them are from operations. That's the first thing to identify. The second thing to take note is that this numbers given, these numbers 2322, so current assets, current liabilities, those are balances. So this net working capital is a balance. Okay. Now, in the free cash flow calculation, we don't want the balance. Okay, we have to work out the balance, but we don't want the balance. What do we want? We want the change in net working capital. Okay, so this is the amount that we want. So in a question where they give you the calculation, they will most likely use these numbers in the calculation, but that is incorrect. You must be using the change in working capital. Okay, so the change in working capital is simply going to be that minus that. Okay, so the change in working capital, this is what we are looking for. Okay, So that is the number we are looking for. Okay, so for the change in working capital, this is the number. So that's very important. So they won't use the change in working capital. They will use the balance. You don't want the balance. Okay, so now I'm gonna go plug that in. I'll use it as is equal. Okay, so that's the change in working capital. Okay, capital expenditure, that's how we get it. If they didn't give it to you, the way you work out, I'm going to put it over here. So the way you get capital expenditure, you do it as follows. You would say, just think quickly now. The way you will get it. So we want to get capital expenditure. Okay, so you will simply just say closing balance PPE minus less opening balance PPE plus depreciation. Okay, so we would be getting that number. Okay, so they didn't give it to you. We'd have worked it out like this. Okay, you just plug in closing balance minus opening balance, add depreciation, and that will give you capital expenditure. And what you're interested in the green highlighted ones. Okay, you don't have to do 2019. Okay, so I'm gonna make it black. You don't have to do that. Only want these ones over here. Okay. Now that is how you would have calculated it if it did not give it to us. Okay. So just take note of that. Okay, so that is basically our cash flow from operations. So as you can see, we got a profit number from operations. Then we adjust for depreciation. Why? Because it's non-cash flow. Then we adjust for changes in working capital, but that's core to our operations. We adjust for capital expenditure, because that is core to our operations. I don't know how to spell this expenditure. No, I don't know. Anyway, okay. So it is core to expend. How do you spell expenditure? Got nothing. Okay, so there we go. Okay, so equal sum. Okay, and then now over here we'll put in our terminal value. Okay, or another word they use, continuing value. Okay, whichever one you want to call it. Okay, so now we're going to put in our continuing value. Okay, so here I'll have working 1. Here I'm going to have working 2. Okay, so over here for working 2, the formula for our continuing value, so our terminal value equals free cash flow, the last date of the explicit period, multiplied by 1 plus the growth rate, okay, divided by WACC minus the growth rate. Okay, so all I'm going to do is I'm going to put those numbers in over here. So we need the free cash flow at our last explicit period. So our last explicit period is 2022. Okay, then we want our growth rate, and then we want WACC. Okay, and that is going to give us our terminal value. Okay, so this will give us our terminal value. Okay, so that's going to give us our terminal value. So the free cash flow for 2022 is going to be that number over there. Okay, the 351,554. Our growth rate was given to us as 6%. Okay, so our growth rate, go look at the additional information and you'll see the growth rate was given to us as 6%. Then we must do WACC. They never gave us WACC, but they gave us information to calculate WACC. So this is going to be working 3. Okay. So before I get there, I just want to explain in the same way that I told you earlier regarding this question over here, that if they have to give you the calculation, then they ask you to critically evaluate. Okay, so one of the numbers that will have the most errors is going to be this terminal value. Okay, one of the numbers that will have the most errors if they ask you to evaluate is going to be the terminal value. I'm going to do the calculation first, finish, and then I will explain to you where the typical areas that will be incorrect in this terminal value. Okay. So there's a lot of areas where there will be mistakes that you must be able to pick up. But let's first calculate it and put it into a number, and then we will deal with it. Okay. So from the scenario, so we need to work out WACC. Okay. So remember, the way we work out WACC is simply going to be sources of finance. Okay. Cost of finance, weighting, and then that will give us WACC. Okay, so that is basically in our scenario, we have debt and equity. Okay, then this will give us our total number. Okay, so this will give us our total. So now let's start to plug in some of these numbers. So let's go and have a look. If you have the scenario open in front of you and additional information, they gave us the target debt equity ratio. So they gave us the target debt equity ratio. So remember, when we work out the weighting, we always want the target capital structure. Okay, so we always want the target capital structure. So they gave us the target debt equity ratio. Remember, the debt equity ratio is not the capital structure, but we can use the debt equity ratio to work out the capital structure. So how do we do that? So they gave us the debt equity ratio. Okay, so debt let me just do that. Debt equity ratio 25%. Okay, this is given. So we can basically work out what that is. Okay, so if we say debt equity and we get total, this is our capital structure. So very important, debt equity is not your capital structure. Okay, your total, your gearing ratio, that is your capital structure. Okay, so I'm going to just say, put it here. Okay, so now we can work it out. In order for the debt equity ratio to be 25%, you can make up numbers. So if debt equity is 25, that must be 100. So if the debt equity ratio is 25%, you can simply say 25 divided by 100 will give you 25%. Okay, so for example, if I say debt is 25, equity is 100, then my debt equity ratio is 25%. Okay, so that's how you think about it. The debt equity ratio is 25, so 25 over 100 give me 25%. So I'm making up the numbers to get to 25%. This will help me with my capital structure. So that means the total capital structure is 125. Okay, so 25% debt, 25 debt, 100 equity. When you say 25 over 100, you get the debt equity ratio of 25%. But for the total capital structure, it is 25 plus 100 equals 125. So therefore, the target capital structure is as follows. 25 divided by the total capital structure and 100 divided by the total capital structure. So my capital structure is 2080. Okay, my debt equity ratio is 25%, and my capital structure is 2080. Okay, so just take note of that. So all I will do is I will put it over there. Okay, so there we go. So the debt equity, it's a little waiting, I'm sorted. If I go back to the scenario, they told me my pre-tax cost of debt is 12.5. Okay, so my pre-tax cost of debt is 12.5. So basically, KD, so my cost of debt after tax is equal to KD multiplied by 1 minus T. Okay, so um, okay, so this is going to be KD T that's going to be cost of debt after tax. Okay, so they gave it to be as 12.5%. I know my tax rate is 28%. So 28%. So all I can do is equal cost of debt multiplied by 1 minus the tax rate. Okay, so that is 9%. The cost of debt is 9%. Now I can work out cost of equity. Now I can work out cost of equity, KE, the information they provide. So remember, to work out cost of equity for WACC, there are three methods. Using the dividend growth model, using the CAPM model, using the risk yield plus bond, the bond yield plus risk premium. Now, how do you know which one to use? You need to know the formula of each. Once you know the formula of each, you'll be able to pick up from the scenario. So based on the scenario, they gave us information for the CAPM model. So the risk-free rate is basically the long-term government bond plus beta multiplied by the market rate minus the risk-free rate. Okay, very, very important to take note. This over here, RM is the market rate. Okay, you must take note whether they give you the market rate or whether they give you the risk premium. Okay, this whole bracket over here, that whole bracket represents the risk premium. Okay, so that whole bracket represents the risk premium. In this question, they never gave us a risk premium. They gave us the market rate. Please be very careful on that. Okay, so we will need RF, we will need beta, we will need beta, and we will need RM. Okay, and then there we go. Okay, this will be cost of equity. So RF was given to us as, so they told us The current annual yield on long-term government bonds is 6.25. Okay, so 6.25%. Beta was given to us as 1.15. RM, they told us, they say, while the basket of listed companies in the same sector of Coselo has averaged 16.25. 16.25%. Okay, so now we can use the formula. Risk-free rate plus, okay, beta multiplied by the risk-free rate, multiplied by the market rate minus the risk-free rate. Okay, what's happening over here? Okay, so there we go. Cost of equity, 17.75. 17.75. So now I can work out WACC. WACC is cost of finance times weighting. Now let's just do that. Okay, so we add it up. There we go. WACC is 16. Can we just make it a percentage? There we go. So WACC is 16%. Okay. So over there, I'm gonna highlight it over here. WACC is 16%. So now we can work out the terminal value. The terminal value equals the free cash flow of 2022 multiplied by 1 plus the growth rate, okay, divide by, open bracket, WACC minus the growth rate. Okay, so the terminal value, whatever that number is. Okay, so it is 3.7 million. Okay, so we got the terminal value, and I'll plug it in over here. Okay, so now let me explain the errors that could be in the terminal value. The first thing to take note is the terminal value must not be in year 1 or must not be in year 0. Okay, the terminal value must not be in year 0, must not be in year 1. That's a typical mistake that gets made. The terminal value must be at the beginning of the foreseeable future, okay, where things become stable. So if you look at the scenario, and the last bullet point under additional information, it says, Coselo expects its cash flows to grow at a stable rate of 6% per annum from 2023 onwards. So from 2023 onwards, that is when the terminal value starts. The terminal value starts in 2023, okay? So where do we put the terminal value? The value of the terminal value does not happens, must be placed at the beginning of 2023, okay? At the beginning of 2023. Now, if you remember valuations, if you remember capital budgeting, each column over here represents the end of the year. So this represents the end of 2020. This represents the end of 2020, the end of 2021, the end of 2022, the end of 2023. So because this represents the end of 2023, we can't put the terminal value in 2023 because the terminal value does not represent the end of the year, it represents the beginning of the year. As a result, the beginning of 2023 is basically the same as the end of 2022. So that is why we put it over there. So that's very, very important. The terminal value is placed at the beginning of the year when the terminal value starts. So that is the end of the explicit period. Okay, so remember the terminal value will go in the last year of the explicit period. That's important to take note. They will most likely put it in year 1 or in year 0. So you must be aware of that. Then you must take note that the cash flow number that you use over here must be the cash flow of the last explicit period. The growth rate that you use must be the growth rate of the foreseeable future. And this rate over here must be, the discount rate that you use must be the weighted average cost of capital. Just take note of that. Then obviously, for each of these, you can have a look if there's more mistakes in it. So for example, they could have easily made a mistake over here. They could have simply used 2575, but it's not actually 2575, it is 2080. So things like that you must be able to pick up. So just make sure you're able to do the calculation, but you're also able to evaluate when a calculation is given to you, and you must spot the errors. Okay, so just take note of that. Okay, so now with this in place, we basically now have the value of operations. So this here is value from operations. Actually, no, not actually. This here is net cash flows. Okay. Okay, then we have discount rate. The discount rate will always be WACC. And now we have our value from operations. Okay. So just have a look what we just did. We started with profit after tax, and we're getting to a value from operations. What's the value from operations? We start with the profit number, and we adjust for two things: non-cash flow and non-operational items. So here we adjusted for non-operational items, and we took the tax effect into account as well. Then we adjusted for non-cash flow. We got which is depreciation. So there so that gives us a profit from operations. Okay, but we need to take into account working capital and capital expenditure. Without capital expenditure, there's no operations. So therefore, that forms critical to our value from operations. Then we bring in our terminal value. Why? Because we only value for 3 particular years, known as our explicit period. Now we need to value to the foreseeable future. That is what the terminal value brings, the foreseeable future, okay, all the remaining years. Okay, so now we have basically our free cash flows from operations. This is basically our free cash flows from operations, but we don't want free cash flow, we want the value, right? So the way we get the value is by discounting using the appropriate discount rate, which is our WACC rate. Okay, so just take note of that. So now value from operations, I'm going to say equal NPV. It's going to be the discount rate. Then it's going to be cash flow 1, cash flow 2, cash flow 3. Okay, so our value from operations is this 3.1 million. Okay, now we don't want value from operations, we want equity. Okay, so I'm going to show you something. We have the accounting equation, assets equals equity plus liabilities. Okay, so that is basically assets minus liability equal equity. Okay, what are we interested in? We're interested in valuing equity. Okay, but the assets can be broken up into non-current assets plus current assets minus non-current liabilities minus current liability equal equity. Okay. Okay. So what you will see over here is the following. If you look at assets, non-current assets, we have some of it. Okay, we have some of the non-current assets, which is the capital expenditure. Okay, current assets, we have all of it, which is the working capital. Under non-current liabilities, we don't have any of it. We must still bring it in. Under current liabilities, we have everything, which is the working capital. So what is the left? We still need to add up the non-current assets, that is non-operational, and we need to still add up the non-current liabilities. So all we're going to do over here is do that. So if we go to the scenario, where did I see that now? If we go to the scenario under the additional information, under the additional information, which is the short-term deposits. Okay, so the short-term deposits, we must bring that in additional information in notes number 3. We must bring in the short-term deposits. So we must bring in short-term deposits. So basically, what we want to do here is add non-operational assets. Okay, so we're going to list the non-operational assets, which is our short-term deposits. Okay, this will give us when you add your non-operational assets, this will give us enterprise value, okay, which is your total assets. Then we're going to say less liabilities, okay, and in this case, it's going to be long-term loans, okay. Then this will give us basically a value of equity. So that's basically what we want to get to. Okay, so our long-term loans, it was given to us as 500 million, 1, 2, 3. So for example, if you go to the notes, they told you in note number 2, interest expense relates to a long-term loan which has a market value of 500 million. Okay, so just to make sure I get the number right, I'm going to say equal minus 500 million. That is 500,000. 500 million, and we divide it by 1,000. Okay, just to make sure that the numbers are right. Okay, so we must put the market value. Okay. Okay, so we must put the market value. So the only other non-core operational assets, is the short-term deposits. So we need to go work that out. Okay, so let's go work that out. So I'm going to go to workings, under working for. Okay, so I'll do working for over here. So for working for, so they gave us in note number 3, they told us what is our, that we have a capital, we have Kusila invest excess cash after considering the operational requirements and capital investments in the short-term deposits. The cash is expected to earn a pre-tax rate of 11% per annum. Okay, so let me just quickly see how we're going to work this out. Okay, so remember when we have an investment that is forever and ever. Okay, so we use the perpetuity formula. So present value or market value equals payment or income, basically. Let me just say income divided by market rate. Okay, so we know what the income is. They gave it to us. the market rate. They gave it to us, so it will give us our present value, our PV, market value. Okay, so we know that the income that they're earning is 23,307. Okay, the rate given to us is 11%. So we can kind of work out what the market rate is. It is that divided by 11%. So the value, the market rate of this thing is that number over there. So all I'm going to do, I'm going to go slot it in over here, equals, which is that, tell them working for. So if the enterprise value would be the value from operations plus non-operational assets, then the value of equity is going to be that my it's going to be the enterprise value, which is the value of total assets minus liabilities. So that is the value of equity. Okay. But now, before you work out the 60%, so this is value of equity at 100%. Okay. Remember, we want 60%. So what's important to take note, you must ask yourself, should you add a majority premium or should you add a marketability discount? So remember, it is a listed company that want to buy us. We are unlisted. Okay, so we are unlisted. So therefore, they would apply a marketability discount. You can make up the whatever rate you want to use. Typically use 5%. So marketability. So when you're unlisted, we apply a marketability discount, and I'm going to say 5%. You can make up whatever rate you want. Just use 5% to be safe, unless I tell you. Okay, so we will say that multiplied by 5%. Okay. So now we have adjusted value of equity. And now you can work out the 60% interest. Okay, so it's adjusted value of equity. I like to just make a note for myself that this is 100%. You don't have to say that. So now you can say value of 60% interest. It will be that times 60%. So what we get over here, the value we get over here is 1.6, whatever that answer is. Okay, so 1.6. So that is basically what I would have gotten. Remember, your number may be different over here, because maybe I've used a different discount rate. That's totally fine. It just needs to be reasonable. Okay, so I just usually use 5%. Do you guys have any questions that you want to ask? For me, it is more the thought process that is important, because every time the question will be slightly different. Okay, so every time the thing will be slightly different. So it's important that you actually use the right numbers. Okay. You guys have any questions? Madania, Nondomiso, Shaheen, there you go. Okay, Nondomiso, no. Madania, Shaheen, there you go. Any questions on your side? Nothing, okay. Madania, your side, anything? There you go. Anything your side? No question. I'm happy that you found it useful. So for me, it's more the thought process important. So tomorrow will be a similar time. We'll do financial instruments unless there is something else you want to cover. But if you all happy with financial instruments, and tomorrow I'll be covering a financial instruments question, also like an 18 marker because it takes me like in a 90-minute session, I do like a 20 mark question because of like the way I want to go through the question. If I must do like a 40 marker, then we're just going to be running through the question and no explanations. So because I follow this approach, I do like a 20 marker. So I'll look for a financial instruments question that is around 20 marks. Okay. If there's no other questions, then we're good to go. I'll send you guys the link to this question once it's ready. Okay. Hey guys, thank you very much. Bye-bye.
Bye.
Bye. Thank you so much.
Mhm.